So you're thinking about becoming a guarantor. Before you do that, you'll want to read the terms and conditions, but let's face it, no one reads the terms and conditions. So let's do it together. The first thing, and really the main thing, is your responsibility. The two big things that you have to do, one is you have to take the money from the loan company and give it to your borrower, or the person you're guaranteeing the loan for. That might seem quite obvious and quite easy, but actually some issues do arise from that. One of the issues is when the borrower claims that they never received the money from you, and there's sort of nasty standoff between you, the company, and the borrower. The second thing here is basically the next three bullet points are fairly standard in the sense of what they're saying is that if the borrower doesn't pay, you have to either make the next payment, or if it's defaulted, you need to make all the payments straight away, or at least you're due to make all those payments straight away. The other point here, which is a little bit more subtle, is you are also being asked to indemnify, as in kind of give a guarantee, if you like, for the company against any claims that the borrower might have against them. So if the borrower tries to sue the loan company for whatever reason, actually the loan company can claim that money back off you. That's a slightly weird thing in a way, but basically it means that the borrower effectively has a few less rights than they would do if it was a normal loan. Okay, breaking the agreement. The thing here is this is the sort of scary paragraph. This says that they may obtain an attachment of earnings. They may deduct the money from your salary if you can't pay them immediately. They may send around the bailiffs, or they may get a charging order on your house. A charging order basically means that if you sell your house in the future, their debt gets paid first before you get any money from that. So these aren't just words on paper. In order to put this in the terms and conditions, they have to do it sometimes. I don't know how often they do it, but given guarantor loans are often sort of relatively significant amounts of money, £5,000-6,000, they probably do it more often than you'd think. Okay, continuing the guarantee. I think there are two bits here you might want to just think about. First is this one, which I don't quite understand actually, which says you will continue making the guarantee even if there is a change to the borrower's credit agreement. So, for example, if they put the rates up on the agreement, they could, your guarantee is not affected. And actually, I think it means that if they lend more to the underlying borrower, you still have to guarantee it. If that's the case, that's quite dodgy, and you should probably clarify that before you sign up. The other thing to be aware of down here is that the borrower, if the borrower goes bankrupt or gets some kind of debt relief order, does an IVA, which is a form of bankruptcy, they are off the hook for all their debts. They don't have to pay any more or only pay a certain amount based on the terms of the bankruptcy. But you are on the hook for the whole amount. So you would have to do an IVA, or you would have to go bankrupt for this debt to be written off. It's not enough for the borrower to go bankrupt. The steps below, or the paragraph below, is card payment authorities. Two bits here which draw your attention to. It's when the card payment authority is when they use the debit card that you give them to just take money out of your bank account. They won't do this straight away after the borrower has missed a payment. They'll wait for 15 days, there on the 15th day, and they will also have tried to contact you. So essentially there's sort of 15 days, 2 weeks grace before they go for your bank account. If they do go for your bank account, one thing to remember is if the money's there, okay, that's great at one level. I mean, it's sad because you had to pay the money. But if the money's not there, they will carry on trying once every 3 days. So that means that if you're above an overdraft limit, for example, you'll keep on racking up overdraft fees. Again, something to be aware of. The rest of this is all all fairly kind of simple and sage. The bit here around independent advice, they probably put it in just so that, you know, they can tell you you've put it in and they can point to it if there's a problem in the future. But actually, really, you probably should take advice. It's a serious thing, guaranteeing someone's loan. The rest of it is, you know, I think pretty standard. You know, if you have a complaint, you can complain to them or to the ombudsman. One thing I'd just like to point out, which is a bit unusual, is what goes on with credit reference agencies. So obviously they will check with a credit reference agency before letting you be a guarantor. What they say is that won't show up in the credit score of one of the credit reference agencies, like your Experian score, your Equifax score. However, that doesn't mean it won't impact your ability to get credit. Other lenders will see that you are a guarantor, and they may take that into account when deciding to lend to you. So you need to understand that actually this might impact your ability to borrow in the future. The rest of it, I think, is all fairly standard. So those are the key points. Yeah, understand you really are on the hook. They really could take money straight out of your bank accounts, and it might impact your credit. But if you're still happy to go ahead, by all means do so.